Okay, thank you so much. Thanks so much for having me, and thanks so much everyone that's joining. Let me share my screen really quickly. Oops. Okay. Okay. Um, it's coming up okay? Slides are
Yes,
coming up
good.
okay?
Looks good.
Okay, great. So thanks so much again for having me, and thanks so much everyone for tuning in. This is joint work with Lars Lochstoer, my colleague at UCLA, and the title is Volatility, Expectations, and Returns. So let me give a broad overview of what we're going to do in the paper. We're going to start from really a cornerstone of asset pricing, and kind of a cornerstone of finance in a lot of ways, which is the trade-off between risk and return. So here I have an equation. On the left-hand side, I have the conditional market risk premium or equity risk premium. And in a lot of our asset pricing models, that should be a function of risk, of market variance. So think about a simple power utility model or mean variance model. It's going to tell you higher expected variance, higher expected volatility should go hand in hand with a higher market risk premium. Now, empirically, this has posed a bit of a challenge because this risk-return trade-off, when you look at the data, is typically weak, or if anything, has the wrong sign. And I'll cite a really long literature. We're not by any means the first to be documenting that. But the challenge with that is that this is really strong in our model. So while various asset pricing models might not look exactly like this equation here, if you run a regression in any kind of mainstream standard asset pricing model, whether it's power utility, a model with habit preferences, long run risk, even models with intermediation, rare disasters, and so on, what you'll typically find is higher variance should be associated with a higher market risk premium, okay? But that doesn't seem to be showing up in the data. So what are we going to try and do in this paper? We're going to try and tackle this challenge a little bit. And the way that we're going to try to do so is we're going to allow for biased beliefs about risks, about market variance, let's say. Okay, and I'm going to start to try to convince you of that. I'm going to start by looking at some survey evidence of agents' expectations about volatility or variance. And what I'm going to show you is that survey evidence looks like agents place too much weight on past volatility and not enough weight on current volatility, okay? So that's what the survey evidence is going to look like. And what that's going to generate is initial underreaction to volatility, and then followed by delayed overreaction to volatility, okay? And that's going to show up in the risk-return trade-off in the data in a way that I'm going to make more precise, okay? It's also going to show up in claims, direct claims to volatility. So think about variance swaps, VIX futures, straddles, things like that, where the payoff depends directly on future realized variance or volatility. This underreaction or delayed overreaction should then show up in the prices of those claims. Okay, and I'll again try to make that precise, and we'll see that it appears to. Then what we're going to do, once I've showed you the surveys and some of these volatility claims, is I'm going to put those beliefs that kind of match the survey beliefs into a general equilibrium model and argue that we can explain this weak risk-return trade-off that I alluded to initially, plus a bunch of other patterns surrounding volatility and stock returns. Okay, so that's kind of the goal. Let me give you all the intuition of the paper, or try to give you all the intuition of the paper in one slide. So here what I'm plotting is the response to a shock to variance at time zero, okay? So time zero here, let's say we get a big increase in variance. Let's say there's a shock like, COVID or the financial crisis, or even just a smaller regular increase in volatility. The red line here is going to dictate agents' rational beliefs. So volatility is going to spike up after the shock at time zero, and then it's going to just sort of mean revert back down over the coming months. I want you to think about on the x-axis these periods 0 out through 12 as months, okay? So out to about a year. So volatility is going to spike up and then mean revert back down. But what we're going to have, the agent's beliefs about volatility are going to respond a little bit more slowly. Okay, so they're going to be kind of this weighted average of volatility in the past. So when volatility initially increases, agents are going to underreact. So this blue line is their beliefs. Okay, they're going to undershoot a little bit. They're going to be slow to react. And then later on, they're going to be sort of overreacting in periods kind of 2, 3, 4, and sort of beyond. Okay, so they're going to have this kind of sluggish pattern in their beliefs. So what that's going to mean is if I think about claims that depend directly on future volatility, let's say a variance swap, VIX futures, things like that, it's going to say that those claims are basically underpriced at time zero, that insuring against future volatility after a volatility shock is going to be cheap, okay? Because agents aren't updating enough about future volatility. And then later on in periods 4 or 3 here, agents are going to sort of be overreacting, right? So insurance against future variance is going to be really expensive at that point, and that should show up in those prices. Now in the model, because agents are going to be risk averse, that's also going to translate directly into stock prices. And that's what I have in the bottom panel here, okay? So stock prices, naturally when volatility goes up, stock prices are going to fall through a standard risk aversion effect, right? If I'm risk averse, future higher risk in the future is going to lead me to push stock prices down. So that's going to happen at time zero, and that's consistent with the fact that we usually see the stock market fall at times when volatility increases. Okay, so we're going to match that pattern at time zero. But then, since agents are responding a little bit slowly to volatility, stock returns can fall additionally between period 0 and period 1. Okay, so that can make the risk return trade-off sort of weak or even possibly negative here, right? I'm getting an increase in volatility at time zero, but I'm seeing stock prices fall over the next month. Okay. So that's kind of all the intuition that's going on in the paper. And let me explain the stylized facts that we're going to try to match with this. So these are really coming from an existing literature on risk and return. So the first thing is variance forecasts don't seem to predict future stock returns. This, again, there's a really long literature. I'm just citing one paper, this Gloston, Jagannathan, Runkle paper from 1993, but there's a much longer literature on that. That also implies a role for volatility timing, that basically if you're not getting higher return, but risk is higher, then you can sort of avoid those periods and increase your Sharpe ratio. That relates to some work that I've done previously with Alan Moreira. So we're going to be able to match that fact. But also importantly, realized stock returns do fall, stock prices do fall when variance rises. So that's consistent with agents being risk averse towards volatility. So we're going to kind of jointly match both of those things. Next, the variance risk premium, or looking at VIX minus realized volatility, does positively forecast stock returns, and I'll explain how we're going to get that in the model. But again, this is coming from this Boleslav paper from 2009. However, risk neutral variance, if you just look at the VIX, that also does not strongly predict stock returns. Okay. And then the last fact, which I'm going to go into in much more detail, is that the expected return on shorting claims to future volatility, so let's take VIX futures as an example, falls when volatility rises. That's the point I made earlier, that it looks like it's cheap to insure against future volatility after volatility has just risen. Okay, so that's consistent with sort of underreaction to volatility. I point you to this paper by Ing-Ha Cheng that documents this. So all these facts are kind of documented elsewhere. We're going to try and put them all together. And then Ing has a nice follow-up paper to that, looking at the COVID shock, which was a huge increase in volatility more recently, and arguing that agents underreacted to that as well. let me summarize where most mainstream models fall short on these facts, and then I'll talk about how we're going to address them, and then I'll pause and kind of take some questions in just a sec. So standard asset pricing models can match fact 2, that returns fall when volatility rises, consistent with a discount rate effect, that agents demand a higher risk premium when volatility is going up, but they're going to be strongly counterfactual on facts 1, 4, and 5. The fact that volatility forecasts don't seem to predict returns, whether or not it's objective volatility forecasts or risk neutral ones. And they're going to be counterfactual on the variance risk premium actually falling after volatility has just risen. Okay, so that's where we're going to come in with this beliefs channel and try to square all of those facts. Okay, so let me pause here and take any questions. It's kind of a broad overview, if there are any.
Sure, there's a question, Tyler. So the question is, so do you mean agents underreact to unexpected volatility or shocks to expected volatility?
Yeah, it's going to be shocks to expected volatility. That when expected volatility has sort of objectively risen, agents don't update their beliefs about volatility enough. So that's the sense in which they're going to underreact in the short term. Good. Okay.
Okay, we don't have another question right now. I will ask you more in the future.
Okay, great. So I will keep going. So here's a broad outline. I'm going to show you the survey evidence first, and I'm going to argue that that survey evidence points to beliefs not being fully rational. Then I'll revisit some of these stylized facts that I was just hinting at on the relation between stock returns and variance. I'll describe why the mainstream models aren't going to match all of those patterns, though they might match some of them. Then we're going to embed those beliefs into an asset pricing model. It's going to give you the intuition that I just showed you with that kind of impulse response. And then we're going to try to quantitatively see if we can match the facts that I showed there. Okay. And then I'll also show some evidence that the variance risk premium in the cross section are consistent with the model beliefs channel. So there I'm going to look at firm level implied volatility and show you some evidence there too. Okay. Let me start with the surveys about how agents form beliefs about volatility. So we have 2 surveys here, and I'll talk about a little bit pros and cons of each one. The first one I'm going to start with is the CFO survey from Graham and Harvey. So this has been studied for forecasts for mean returns, for expected returns. We're going to use it to get estimates of forecasts about volatility. So this is a quarterly survey done since 2001. And the respondents, they're asked for a mean forecast of stock returns, but they're also asked for the 90th and 10th percentile of the distribution for stock returns over the next year. Okay. We're going to take the difference of those two, the 90th and the 10th percentile, as a measure of uncertainty. And we're going to square this difference as a measure of variance. Okay, so that will exactly correspond to expected variance under the assumption that they believe stock returns are normally distributed. If they're normally distributed, this will correspond 1-to-1 to that. Okay. We also have a survey from Schiller that is monthly since 2001, where respondents are asked for the probability of a stock market crash over the next 6 months, something like what they saw in the 1987 crash. Okay. Now, that one has a little bit of another challenge, which is it's not exactly volatility. It's a little bit more downside risk, but it's still getting at agents' expectations about risk over the near future. So neither one of those is perfect, but they're certainly going to be correlated with return variance expectations. Again, the first one, if agents believe that stocks are close to normally distributed, will correspond exactly to variance. And we also know that beliefs do translate to portfolio decisions. So Stefano Giglio and co-authors have a paper showing that agents' perceptions of risk do change their portfolio allocations. Okay. So here's what we're going to do. Let me start with the CFO survey. So I have the survey at time t. So let's say it's today. you're asked about uncertainty of stock returns over the future, over the next 1 year, okay? And I'm gonna regress or estimate those survey expectations being on the left-hand side, and I'm gonna put a bunch of lags of realized variance on the right-hand side, okay? And I'm gonna estimate this phi parameter here, where we've imposed that it's gonna be this exponentially decaying effectively average of past realized variance, okay? So the smaller is phi, the more weight you're putting on recent volatility having been high, and the larger is phi, the more you're putting weight on volatility having been high, you know, a year ago or even longer than that, okay? So this specification maps really closely to the literature on sticky expectations, and it also overlaps if you've seen papers on extrapolation or experience effects or things like that. And the other thing that I'm going to do here is I'm going to estimate this phi where I replace the left-hand side, instead of with their beliefs, with the actual realized variance over the horizon that investors are going to forecast, okay? So this phi parameter allows us to capture their beliefs with basically a single parameter. You could also just take the survey expectations and regress it on all sorts of different lags of realized volatility, and you're going to find kind of the same things. Okay. Let me show these results, and then maybe this is a good time to take questions, because this piece is important. So here's what we find. The phi that we estimate when we use the CFO survey, we find a phi of about 0.77, okay? So that's a quarterly number. And if we use the Shiller survey, we find about 0.73. So that's saying that agents are putting a lot of weight on realized variance farther and farther into the past. Now, what's really important here is this next column where I have the future variance, okay? That's what variance actually turned out to be over the period that they were supposed to forecast. And if they have rational expectations, those two numbers should be basically the same, okay? And what you find is the phi, when you're trying to forecast future variance, is close to 0, right? So the optimal forecast is basically to pay attention to current variance, but kind of ignore variance over these longer lags. But it looks like agents' beliefs kind of load a lot on these longer lags. Now, we also do this with the VIX, which we're going to think of the VIX as market expectations of variance. So it's also going to incorporate agents' beliefs. And there we recover a phi in a similar ballpark. We get about 0.5 instead of about 0.7. Okay, so this is also showing up in the VIX as well. Okay, so let me pause here. I think this is a good time to maybe take questions.
Sure, we have a couple of questions. So the first one is, so can your model explain the Stein 1989 paper where they show that long-term implied volatility overreacts to shocks to short-term implied volatility?
Yes, it will match that exactly. And so when I was citing all of these papers in the literature, there's kind of like too long of a list to name in there, but this is also really good motivation, the Stein 1989 paper. So there it's kind of longer term overreaction, and we're going to get that too through the model.
Okay, cool. So another question is, if agents believe stocks have fat tails, are these surveys capturing higher moments?
Yeah, so that one is a little tricky. With the CFO survey, one thing that we can say is we have the 10th percentile, the 90th percentile, and the mean, right? So what we can basically say is the 10th and 90th percentiles look fairly symmetric around the mean. So it doesn't look like there's a lot of like skewness in the survey measure, but I kind of take your point more generally that maybe what agents care about is sort of this downside risk instead. And there, the Shiller survey is trying to get much more directly at that, because there it's really asking about kind of crash risk, downside risk, and not so much about the upside. Yeah.
Okay. So another question is, in the GARCH literature, people are talking about shock decay parameter. So can I interpret your results as investors systematically miscalibrate this parameter?
Yes, that's a great point. So thanks a lot for that question. So in some sense, you could think of this fee in kind of that GARCH framework, but what we're saying is exactly the question being asked, that they're putting too much weight on that, right? So maybe it's not a crazy model to use. We're not necessarily saying that. We're saying that they're getting maybe this decay parameter wrong, and they're getting it wrong in the direction that they seem to put too much weight on kind of past lags, and therefore not enough weight on kind of the current realized volatility.
Okay. Does the estimation model consider that the volatility is second order?
So I'm not sure I fully understand that question.
Me neither. Maybe like he will provide more detail after. So another question is, do investors underreact to negative shocks to expected volatility in the same way as they do to positive shocks?
Oh, that's a really good question. The short answer is I don't know, and we haven't explored that. In the model, it's going to be symmetric. Now, in the data, I'm not going to show you any evidence either way, whether it's a negative or a positive shock. So that's a good question. We haven't looked at that.
Okay, and the last question is, why do you think investors underreact to shocks to volatility? I mean, is it because they can't distinguish between information and noise, but adjust over time?
Yeah, that could be one reason. So we're not going to take that strong of a stand on this part as to exactly what the microfoundation is. One way to microfound all of what we're doing here, which we've shown, we have in an appendix, is if agents are heterogeneous, but some agents kind of aren't updating as frequently, you can get that the aggregate belief looks like it underreacts, even if it's not all agents underreacting. So that's sort of one way to microfound this, but we sort of don't have anything in the data that really is going to allow us to distinguish between that or sort of separate that from other different microfoundations. So in the behavioral literature, there's different ways in which you can get underreaction and delayed overreaction. And we're not going to take too strong of a stand here on exactly what might be causing that. I think that's really important, but we kind of just, we don't know of anything in the data that's going to allow us to like really separate that.
Okay, thanks, Tyler. We can move on.
Okay, great. So thank you. Those are all great questions. Now the next thing that I want to show is, some people might view surveys as like, okay, that's kind of cute, but we don't actually think that that's going to show up in actual market prices, right? These are surveys of CFOs. Maybe they're not the ones pricing volatility. So do these mistakes actually show up in market prices? And here, again, I want to point you to this paper by Eng-Hak Chang, which is closely related to this, this result of agents underreacting to volatility. And we're going to just sort of expand his results a little bit and show something slightly different. We are going to now look at the returns to claims that are short volatility or variance. And I'll talk about the various ones that I have down here, okay? And so the basic idea here is going to be, if investors believe that volatility is higher than a rational forecast sort of says it should be, then the returns to shorting volatility should be high, okay? And so here, I have this sigma squared hat here. That's a real-time variance forecast that we've constructed from intraday data. We've kind of played around with all sorts of different volatility models, so I won't get into all the differences between those. They kind of all largely point to the same thing. And then I'm going to regress returns that are short volatility. So this is column 1 is short VIX futures. Column 2 is looking at straddle returns. Columns 3 and 4 are 2 different ways of constructing variance swap returns. And I'm going to regress those on this real-time objective forecast for volatility. That's what I have in the first row. And then the second row is this fee-weighted average of past volatility, okay? And I'm going to calibrate this phi parameter to 0.6. That's somewhere between the surveys and the VIX data that I showed you before. You could use other measures of phi as well. So think of the second row as what we're calling agents' expectations of volatility, and the first row as more of an objective forecast of volatility, okay? And so you can see this is basically showing up in terms of being able to predict these returns, right? That when investors believe volatility is higher than the rational forecast, the returns to shorting volatility are high, right? So you always get a positive coefficient in the second row, and you're getting a negative coefficient in the first row, okay? And that's true kind of across the board here for these various measures of claims that depend on future volatility. Now, importantly too, let me talk about columns 5, 6, and 7. So columns, let me start with column 6. Column 6 is, instead of putting these volatility returns on the left-hand side, I'm just putting next period's actual volatility. And so importantly, this moving average, or this weighted average of all these lags of volatility that it looks like are showing up in the surveys, doesn't help you to predict future volatility at all once you've controlled for this forecast, okay? But if you look at column 7, right, that weighted average does show up when you look at market expectations of volatility as measured by the VIX, right? So the VIX seems to depend on those past lags of volatility in addition to the sort of objective forecast. Okay. I don't know if there are questions on that, but if not, I will move on. So again, all of that is just saying this does seem to show up in terms of sort of what look like mispricings in claims against volatility in exactly the way that the surveys sort of predict it would. Agents are placing too much weight on volatility farther into the past, and that is leading to predictability or mispricings in volatility dependent returns. Okay. Let me just talk now about risk and return in terms of the stock market. So now, instead of looking at these volatility claims, I'm going to look at, on the left-hand side, the returns on the overall stock market. So this is the CRSP valuated index, the market return that you would get from Ken French, okay? Excess market return. So that's now on the left-hand side. And now I'm showing you the risk-return trade-off is weak. So take a model of expected variance. That does not seem to predict higher future stock returns. I already showed you that it predicts higher future volatility, right? So we know that it's predicting higher future risk, but it's not predicting higher future returns. So that's columns 1 and 2. So in columns 1 and 2, you basically are seeing nothing there, right? Column 1, you get a negative sign, but not significant. Column 2, if you use the VIX instead, you get a slightly positive sign, but also not significant. And the adjusted R-squareds here are basically 0. Now, while neither of those forecasts of volatility predict returns, the difference between the VIX and the expected variance measure that we have here does predict returns positively, okay? So that's straight from this Boller-Slev paper. That's not a new fact, although we're updating that in the current sample. And in the model, the intuition for that is going to be the VIX is going to embed agents' beliefs, which might be biased. And so the difference, the fact that these two coefficients are significant, but exactly of opposite signs, is going to be about the mistake in investors' beliefs being the thing that predicts stock returns, and not actually the forecast of future risk, okay? Okay. All right, so that's a lot of different facts kind of floating around all at once. I want to now kind of characterize all of those facts and all of those patterns with kind of one simple graph. And so to do that, we're going to show an impulse response. So we have a VAR, and what we're going to put into this is realized variance. we're going to have the excess return on the market, we're going to have the VIX, and we're going to have the market price dividend ratio. Okay. Realized variance is going to be ordered first in the VAR. And then the realized variance risk premium is going to be the VIX. So that's market expectations about variance minus actual realized variance over the next month. Okay. So it's going to be the difference between the market implied variance and sort of the actual variance over the next month. Okay. So here's what that impulse response looks like for a shock to variance. So this is kind of going back to the graph that I showed you at the beginning. What happens when expected variance sort of goes up? Okay. This is in months on the x-axis, and the upper left panel is what happens to variance. Okay. So obviously, when variance increases at time 0, naturally you're going to see this big jump up. Okay, and then there's kind of just a decay back down over the coming year as volatility or variance basically mean reverts back to normal. Okay, so that's consistent with the kind of rational forecast that I showed you in that first picture. Now, what's going to happen to stock prices? Okay, that's the upper right panel. Stock prices are going to fall on impact, right? So volatility goes up, prices go down. But what's surprising here is that stock prices are not only going to fall at time 0, they're going to sort of continue to fall from time 1 to 2, and then only increase in months sort of 3 and beyond. Okay, what that's going to mean, if you look at the lower right panel, so that's the equity risk premium, it's going to mean that the initial equity risk premium is going to look like it's negative. So volatility has gone up, and the risk premium looks like, if anything, it has gone down, right? That's consistent with prices sort of continuing to fall. Then the market risk premium is going to sort of slowly rise with this sort of hump-shaped pattern farther out as prices recover. So in some sense, think of the lower right panel as the derivative of the upper right panel in prices. Okay. Now the variance risk premium, which remember, that's the difference between market implied volatility or variance and the actual, is initially going to go down. Why is it going down? Because agents are underreacting to volatility, right? So that the expected volatility is not rising enough. And then it's going to overreact later on with the sort of same hump-shaped pattern. So that farther out, the variance risk premium looks positive, meaning market expectations are too high relative to a rational forecast. Okay. Okay. This seems like a good time to pause for questions too.
Sure. So the first one is, the survey data seem to be capturing relative intermediate term variance, for example, over the next year, whereas your empirical analysis is based on much shorter term measures of variance. Are these typical the same?
Yeah, that's a great point. That's a little bit unfortunate from the perspective of the survey. I agree. We would kind of like something that was shorter term. Unfortunately, that's the only thing that we have to capture in that survey. But it still is the case that if you try to form an objective forecast for volatility over the next year, based on what I showed you, that mostly loads on volatility sort of today, and not so much on volatility a year ago, conditional on knowing what volatility is today. So that's where, if you forecast that future variance over the year, right, the sort of optimal fee, if you want, is relatively close to 0. Now, still to your point, it would be better if we had some survey data that was more in a short term. A little bit, that's what we want to think of the VIX as. So I know that the VIX also is a risk neutral measure, so it's also going to embed variations in the volatility risk premium. But the VIX is, you know, you can almost think of the VIX as a survey of sort of like beliefs about what market participants think volatility is going to be over the next month, subject to the caveat that it also impounds, it's a risk neutral measure.
Okay, so another question is this result driven by the drop and rise in February, April 2020? Do you get the same result without 2020?
Great question. The short answer is yes. A lot of the results, some of the results are a little bit stronger without 2020. Some of the results are slightly weaker without 2020. But one thing that the question I think is pointing to that is important and is a concern for us is that if you look at volatility or variance even more so, the time series of that, there's going to be these occasional really big spikes, right? And so you sort of wonder, are those spikes kind of driving all of the results? And is the regression kind of like loading all on these really high variance periods? And the answer is we're going to show some robustness. I probably won't spend time on it, but we have more discussion of it in the paper of what happens if you drop those really high variance periods. The results are generally robust to that. So I agree that is a major concern, but we show that using logs of variance or volatility or doing all of these regressions using weighted least squares where we downweight the really high variance periods.
I see. So another one is, would your results hold if there's an increase in uncertainty, which unlike a shock can last for a while? I mean, like now it's hard to distinguish past from present.
Yeah, that's a good question. I think it's kind of getting at, in the model I'm going to show you, there's not going to be, you're kind of getting at volatility might have kind of two frequencies, a lower frequency component and a higher frequency component. And if there's a shock to the lower frequency component that we expect to last a longer period of time, maybe it's reasonable then for agents to sort of put a lot of weight on past volatility, and maybe we get patterns that look like this. I don't have time to fully go into that, but the short answer is we show that can't be what's driving the results. So we have a section in the paper on that, but I won't spend too much time on it now. Yeah.
Okay.
It is true though that a longer lasting shock should have different implications for the response.
Okay. The last question is, how do you measure or estimate shocks to realize volatility? Do you use it as a proxy for shocks to expected volatility?
Yeah, good question. In the impulse response that I showed you, the answer is yes. Although we can also form a forecast of volatility using some higher frequency intraday data, put that in the VAR, and we get kind of the same results. But you're right, a little bit I'm conflating those two in what I'm showing you in this picture. Yeah.
Okay, thanks, Tyler. We can move right now.
Okay, good. So this is talking a little bit, this came up, so I'll spend a second talking about this on robustness. These higher variance periods are important. So using logs of variance or using volatility, or like I said, maybe our favorite thing is to use some weighted least squares where we downweight really high volatility periods. We find basically the same takeaways. Some of the facts are slightly weaker. I'll kind of point you to the appendix for all of those results. We've also done this internationally. So we have 9 developed countries where we look at the same kind of facts. We see largely the same things, slightly weaker evidence in Japan, but kind of consistent across the board. The results on variance, we don't have the VIX going back as far or these volatility claims, but results on variance, we can use a much longer sample as well to address that. So going back to like the 1930s, and we see largely similar patterns there. And then, you know, this has come up a couple of times, alternative ways for estimating variance. Is it expected variance or realized? We've kind of done a lot of different models there for forecasting variance and found similar patterns. Okay. So having gone through those facts, let me now discuss how this is going to work in the model. Okay, so all the intuition from the model you should be able to get from that kind of first picture that I showed you. So here's how the model is going to work. We've got aggregate log dividend growth. That's given by this delta D here. Dividend growth is gonna have a constant mean, but stochastic volatility. So that's the thing that we're interested in. And we're gonna model volatility as following an AR1, okay? Or sorry, we're gonna model variance as following an AR1. This is kind of standard in the literature if you think of like the long run risk literature. One problem with this and having this eta shock be normal is that it implies variance can actually go negative. If you're interested in that technicality, we've got a whole appendix devoted to preventing that from happening with largely the same takeaways, okay? So to the question that came up earlier, this is kind of implying a shock to volatility now is also a shock to expected volatility going forward. Okay, so that's the process for volatility. Now, what are agents' beliefs going to be? So this is kind of the crucial feature. We have agents' beliefs about future variance, and I'm going to use this superscript S here. So E to the superscript S stands for subjective. So we're going to allow agents' beliefs to not be the objective beliefs. Agents are going to get the mean right. So V bar is actually the mean of variance. But they're going to form beliefs according to the state variable X here. And let me just jump to the last line. So we've modeled this as this weighted exponentially decaying average of past realized variance. Okay, so that should look familiar from the surveys. That's exactly what we have there. So this phi parameter is dictating how much weight agents put on these longer lags. Now, since volatility in the model or variance in the model is an AR1, it says that the optimal thing to do is to put phi equal to 0. That way you're only putting weight on current variance and you're not putting any weight on the past variance. Once you increase phi above 0, agents are going to be putting sort of too much weight on the past variance and not enough weight on the current variance, okay? And then this lambda parameter is just going to set the scale of agents' beliefs. I'll talk about how we're going to calibrate that shortly. Okay. So hopefully that looks familiar given the survey data that I showed you. This is going to be the response. So to give you the intuition, the response to an increase in variance. So the red line is the rational case. Again, since we're modeling variance in the model as an AR1, that's just going to keep things simple and allow us to solve the model much easier. It's not crucial in the model. Variance is going to go up, and then it's just going to sort of mean revert back down. And then the agent's beliefs, which I have in the blue line here, are going to be this slow moving average, weighted moving average of past volatility. So they're going to sort of underreact initially and then overreact farther out. Those expectations are going to be very much related to the literature on sticky expectations, as well as the literature on extrapolation that people have focused on in other contexts. So most of the extrapolation literature, people focused on implications for expected returns. Here, the main difference is we're looking at expectations about risk and not about returns and how that feeds back into stock prices. And then finally, I kind of said this earlier, but this is one way to get this kind of underreaction and overreaction. There's a longer behavioral literature that looks at that through other mechanisms that gets initial underreaction and delayed overreaction. And sort of we don't have that much to say about whether or not those kind of micro foundations could also generate the same patterns. Okay. Good. So now we have the cash flow process, the process for variance, and we have agents' beliefs about variance. Now all I want to say is what agents' preferences are going to be, and then we can solve for the equilibrium and kind of look at the behavior of prices in the model versus what we've seen in the data, okay? So we're going to have a representative agent. they're going to have the beliefs about variance that I just showed you. They're going to be hopefully trying to match the survey evidence that I showed you. They're going to have Epstein-Zinn preferences. They're going to consume aggregate dividends. And then here is what their pricing kernel is going to be, or their stochastic discount factor. Again, this is standard from Epstein-Zinn preferences. If you're sort of not into the asset pricing, Epstein-Zinn preferences, all this kind of stuff, all we're basically doing is taking those beliefs that I showed you, adding in risk aversion, and then seeing what the dynamics for prices are going to be that come out of that. Okay. How are we going to solve the model? We're going to use the Campbell-Schiller approximation to get an exponential affine model with a single state variable. The state variable is going to be the agent's beliefs about variance, or that X variable that I showed you before. Okay. Let me now talk about the equilibrium quantities that are going to come out of the model. The first thing I'm going to talk about is the price dividend ratio. And remember, X is the beliefs about variance that the agents have. That's going to be the one key state variable in the model. So the price dividend ratio is going to be some constant C minus some constant A times X, times agent's beliefs about variance. Okay? A is going to be a positive number. All that says is if agents believe that variance is going to be high, then prices are going to go down through kind of a standard risk aversion sort of a channel. Okay? What is that going to imply about the subjective risk premium? So remember, if I use a superscript S, it's agent's beliefs, not necessarily the objective beliefs. It's just, they're just going to impose a standard risk return trade-off. So I only want you to focus on the first term here. So on the left-hand side, I have the agent's subjective belief about the market risk premium. That's going to be equal to gamma, their risk aversion, times their belief about variance in the future, okay? Plus some other stuff, a Jensen's inequality term, and kind of some other constant term, okay? So that's basically the risk return trade-off. Oops, okay, there we go. But now the objective risk premium, so now I'm going to use the superscript P to denote objective, is going to be equal to the subjective risk premium plus an additional term, okay? And this additional term, forget about everything that's in front of it, that's just a positive constant, is going to incorporate the agent's mistakes about variance, okay? So what the stuff that's in the parentheses there is their subjective belief about variance minus the objective belief about variance, okay? And so when they think that when objectively variance is going to be really high, but they're sort of slow to respond to it, so their subjective belief hasn't gone up, the market risk premium is going to actually look like it's low or negative. Why? Because next period agents are going to update again about variance and push prices down again, okay? So objectively going forward, the market risk premium can actually go down even though objective forecast for variance has gone up, okay, if agents are sort of slow to react. Notice again, if they have rational beliefs, right, so that S and P are the same, then this whole second term cancels out and you're back to the standard risk return trade-off that we have in most models. Okay. Let me now talk about claims to variance and how agents are going to price those, okay? So when we're going to think about implied variance or the VIX or variance swap returns or all of these different things, the way that we're going to do that is we're going to price the variance claim. So this is a claim that gives you next period's variance, okay? What's the price of that claim? That's what I have on the second line here. It's going to be, we're just going to multiply the stochastic discount factor that agents have times the payoff of that claim, okay, using their subjective beliefs. And basically, the implied variance is just going to be some constant K plus agent's subjective beliefs about variance. Okay. What does that mean for the variance risk premium? Well, the variance risk premium is going to be the price of that volatility claim minus an objective forecast for that volatility claim. Okay, and so maybe not surprisingly, the variance risk premium is going to be agents' beliefs about what variance is going to be minus an objective forecast for what it's going to be. Okay, so that's going to go with all the return evidence that I showed you before. If agents believe that volatility is really high when objectively it's not, it's going to look like it's a good idea to short any claim that depends on future variance. Okay. Any questions on any of those equations, or I'll kind of go into the model calibration and ability to match the data?
No questions so far.
Okay, good. All right. So now we're going to just calibrate the model. We're going to try to use standard values in the literature and target some kind of standard moments. So we're going to calibrate risk aversion to match the equity premium, the EIS to kind of match the long run risk literature. We're going to match unconditional variance, the persistence of variance. The two that I want to highlight here, or maybe the one that I want to highlight the most here, is this phi parameter. So that's the weight that agents put on longer lags of volatility. We're going to calibrate that to 0.6. So that's a little bit lower than what we saw in the surveys, but is consistent with the variance risk premium response that I showed you in those impulse responses. Okay, and I'll show you kind of what happens if you increase or decrease that parameter a little bit. Okay, so a lot of the moments that I'm showing you here in the model versus the data, the model's kind of calibrated to match that, so you shouldn't necessarily be impressed by those. So we chose risk aversion to match the equity premium. We're sort of not after explaining the equity premium puzzle. We chose kind of these other parameters to sort of hit these different moments that I'm showing you there. Okay. So here's what I really want to get to that the model's able to match. The black line, remember, is the data, okay, with associated standard error bounds in the shaded region. The blue line is the model where phi is set to 0.6, so where agents are have biased beliefs, okay? The red is if I turn that off. So the red is if the agents have sort of rational beliefs in the model. So I put phi equal to 0, everything else sort of unchanged. Both of those models, so whether I have phi 0 or 0.6, I can match the dynamics to variance, the upper left panel. We've just calibrated the model to do that. So there's literally nothing whatsoever surprising about the upper left panel. In the upper right panel, I have the response of stock prices to an increase in volatility, okay? And in the rational case, stock prices are gonna go down, but then they're gonna rise for sort of every period thereafter, okay? Another way of saying that is in the lower right panel, in the rational case, the equity risk premium objectively is gonna be high right after volatility increased. That's just coming from that standard risk return trade-off equation. Higher risk means I demand higher compensation or a higher risk premium. Now in the model with phi increased to 0.6, that's the blue line, you can get prices falling initially, but then kind of continuing to fall in periods 1 and 2 before kind of eventually rising, okay? And that's just because if agents are putting this weight on past volatility, even after volatility has sort of come back down, they're sort of extrapolating from a period in which volatility had been high, right? So they're still believing that volatility is high. That's going to kind of continue to push prices down further into the future. That's going to make, in the lower right panel, the equity risk premium look low, or even in the blue line, possibly slightly negative, maybe not as low as we see in the data, and kind of with this hump shape pattern, okay? So that lower right panel is basically breaking the risk return trade-off in the data. Now the lower left panel, which is market expectations of variance minus kind of an objective forecast, that's the variance risk premium piece, okay, is going to go negative at first because agents aren't updating strongly enough, and then is going to go positive farther out because they're sort of overreacting in the longer term. Okay, so the blue matches the data fairly well on that, and in the red line, this thing is just sort of flat. Okay. Questions on this so far?
We have a question.
Yeah.
So you mentioned you choose parameters to fit those moments, and you basically show that price dynamics in the model look like the data.
Uh-huh.
Are there other predictions outside of your main results that you could test so that we can see if your model is rejected?
Yes, there are, and I will hopefully get to that. Part of that comes back to this question that someone asked about the Stein 1989 paper about longer term volatility claims overreacting. So one of the things that we have is if you look at the kind of term structure of volatility claims, so think about not a 1 month variance swap, but a 12-month variance swap or a 6-month variance swap. Do we sort of match those things? And we're gonna argue that we can do that pretty well. But the key thing here is just that the model can get, it's not, given all the intuition I showed you so far, it's not surprising that the model can kind of qualitatively match that impulse response. The two things that I want to say is quantitatively with a fee parameter that's reasonably close to what we see in the surveys, we can get pretty close quantitatively to the price responses. And the second thing is in the rational case, if you turn off the bias, you sort of can't match that. Those are the two things I want to highlight the most here. Okay.
Okay, yeah, this was all.
Okay, good. Let me just give you a little bit of the intuition for what happens as I change that fee parameter, okay? So now what I'm showing you in the different rows in the model is what happens when I sort of increase fee from 0, that's column 2, that's the rational case, to 0.6, where I have in column 4, all the way up to 0.8, so even higher than what we calibrated the model to. And so here I have, current variance and an average of variance over the past 6 months or so. You could do the fee weighted average as well. That'll give similar results. And basically the risk return trade-off in column 2, if agents are rational, is going to be really strong, right? So volatility will predict returns very highly. The more and more you increase fee, the weaker you can make the risk return trade-off in the model. So you can get to a negative coefficient in the model if you increase the fee sort of high enough. And then same thing with, let's jump down farther since I'm running a little low on time. Let's look at this one that says expected variance risk premium toward the end. Again, the more you increase fee, the more the agents are making a mistake, the more they're underreacting, the more you're going to be able to predict a negative variance risk premium when volatility goes up. Okay, so that's just kind of confirming that intuition. Let me quickly kind of compare to this Boleslav Taupin-Zhu paper from 2009. They have rational beliefs, but the way that they get the variance risk premium to predict stock returns is they have the volatility of volatility moving around over time. Okay, so again, I'm not going to go through all the details of this paper, but the key difference from ours is rational beliefs, and this Q variable here is measuring the volatility of volatility shocks. I know that's a lot of volatilities going around, and it confuses me sometimes as well. Okay, so There, because the volatility of volatility is moving around, that's going to generate movements in the variance risk premium that are rational. So agents are demanding higher compensation for variance risk because it's more or less risky at different points in time. And they show that they can get the variance risk premium forecast returns. Now, this isn't like to sort of knock their paper too much. This is kind of a state-of-the-art model. They also acknowledge in their paper that their model has counterfactually strong risk-return trade-off implications, and they leave that issue for future research. Hopefully this is the future research that's trying to address that piece. So let me just highlight what the differences are in their model. So now what I'm doing here is predicting, I have this YT variable on the left-hand side, and I'm using, I'm running a predictive regression with realized variance on the right-hand side. So on the left-hand side, if I use the variance risk premium to predict stock returns, I can get that in their model, which is the black dashed line. And I can also get it in our model, which is the red line, and the blue line is the data. The main point of difference of our model versus there is the upper right panel and the lower left panel. And what those panels are the risk return trade-off effectively. What happens if I put stock returns on the left-hand side and realized variance or the VIX on the right-hand side? And in their model, which is the black line, you should get really strong predictability because of the standard risk return trade-off intuition. And our model is sort of breaking that. Not as much as we would like almost relative to the data, but it's implying a much weaker risk return trade-off than what you see. Okay. I know I have 10 minutes, so I'm going to go a little bit more quickly. The other thing that we're able to match here is the evidence in volatility managed portfolios. So earlier work that I did with Alan Moreira, which is that, well, if I can predict future variance is going to be high at certain times, but that doesn't go hand in hand with higher future returns, then I can come up with a market timing strategy that generates alpha by avoiding high variance periods, right? The intuition is like, I'm not getting any higher compensation for risk, but there's more risk that I face. If I avoid that, then I can increase my Sharpe ratio. So what we did in that paper is we formed this timing portfolio, which takes less risk when variance is high and more risk when variance is low. And we showed that that has positive alpha. And what we show in that paper is that that alpha is directly related to the risk return trade-off for the intuition that I just gave. You're avoiding more risk and you're not sacrificing higher return. We're basically able to match that in our model because the risk return trade-off in our model is weak. So in our model, we can get an alpha for a volatility timing strategy of about 2.5%. That's about halfway there to what we showed in that paper, which was an alpha closer to about 5%, okay? And importantly, in kind of those other standard models I've been talking about before, habits or long-run risk or things like that, it's very hard to match that alpha being positive. Before I go to the firm level data, maybe this is also a good time to see if there's additional questions.
There's one question. So the error seems to be corrected in 12 months, according to the figures. So does that mean investors can learn over time? So why does the bias affect the expected returns persistently?
Yeah, that's a really good question. So basically what's happening in the model is at some point, okay, so we've estimated variance being sort of an AR1 with maybe autocorrelation around 0.7. If you take that 0.7 out to the 12th, you're going to kind of get that shock dying out after around a year. But also if agents' beliefs, even though they're going to depend on past variance, if that fee parameter is not too large, that is also going to sort of die out over time. Hopefully that makes sense. Okay. Now, you're asking like a deeper question about why is it that agents don't seem to learn over time? So why is it that this mistake can sort of persist? We kind of don't have a good answer to that. Lars has spent a lot of time in his career on learning models. We've tried to do a learning model where agents are forming these forecasts in sort of real time based on past data. And maybe it's that what we see in the data is consistent with a learning model. That does not seem to be the case. Now, a better question is, well, why not? Sort of, if these are predictable mistakes that agents are making, and there are sort of ways to improve returns from doing that, why is it that agents don't seem to learn? We basically don't have a good answer to that. The only answer to that I would give you that I do think is important to emphasize is the mistake that agents are making isn't that large in the sense that it doesn't imply that there's an arbitrage opportunity or that you could sort of increase your Sharpe ratio massively in any sense. So in some sense, the mistake is sort of reasonably small. One way to see that in the model is if you take the agent's beliefs about variance in the model and the objective expectation about variance, the correlation between those two is just over 0.9, right? So and this is a good point to pause and kind of communicate this. It's not as if that what the agents do in the model is completely crazy and has no relation to a good forecast of volatility. It's more of a smaller mistake that nevertheless still shows up into prices, but it's not implying kind of a arbitrage opportunity. Okay, that was a long answer, but I guess the short answer is we don't see that much evidence of agents learning over time in the data. All right. Last piece of evidence that I kind of want to show, and then I'll wrap up, is looking at the cross section of options and what the implications for that are. So one important thing is if agents are misestimating variance dynamics, we also expect that this would show up in firm level options data. So in the cross section of option prices. So in other words, agents might also make that mistake with regards to idiosyncratic volatility. So here we have option metrics data from 1996 to 2017. We're getting at the money implied volatility from end of month options. We're comparing that to realized variance over the next month using daily stock returns. And here I'm doing, instead of this weighted average, I'm doing the 6-month change in variance. Part of the reason for doing that is because you have earning surprises and other things that make that fee weighted average sort of a less reasonable thing to do here. But you can see the same thing showing up again when volatility or variance is increasing today relative to where it was 6 months ago. The variance risk premium measured by the implied volatility minus the actual future realized volatility looks like it's negative, okay? So that's true in this third column, and that's also true in this column 6, where now we've included even time fixed effects. So now we've removed any variation due to aggregate idiosyncratic volatility sort of moving around. So this is basically just to say, this mistake seems like it shows up in the firm level option prices as well. That makes a kind of risk-based explanation sort of even harder, especially when we include the time fixed effects that are controlling for any aggregate movements in volatility that are going on, okay? So consistent evidence there. Obviously, we have much more data when we go to the firm level. This we also think alleviates some of the concerns that I highlighted earlier about a relatively short sample with the aggregate data and kind of these infrequent spikes in variance that might be driving a lot of the results. Here we have way more data and we're finding the same patterns. Okay, it's got like 3 minutes. Let me just I've already talked about why standard models, long-run risk, habits, and so on can't account for the evidence. But what about models with, like, let's say, infrequent rebalancing? We've looked at this. Even if only a small fraction of agents are attentive, they'll still price the variance shock correctly if they are rational. If agents know that they won't rebalance soon, they will still ensure sort of a risk-return trade-off at the horizon that they are trading. So this explanation sort of doesn't work either. We've looked at models with heterogeneous agents. They can help match some of the features, but if you try to calibrate those models to also match the equity premium, they kind of also can't square with all the facts. Okay, so we have a whole section on this in the paper if you are interested about why those models can't fully work. And they can't match this kind of delayed hump shape response or the cross-sectional firm level evidence that I just showed you either. Important paper to note as well is this paper by Stefan Nagel and co-authors that show that investors do react to volatility by selling when volatility goes up. And they argue that more sophisticated agents react more. That would be consistent with our model if we view these more sophisticated agents as being closer to rational. Okay, so it does look like there's some heterogeneity in the way investors respond to volatility, that the more rational investors kind of take advantage of some of the things that I mentioned. But remember, the model is a representative agent model, so we're kind of not talking about this cross-sectional patterns across investors. We think this is a really interesting area for future work to go. And then finally, if you want to think about this through the lens of a rational model, you kind of have to throw out the survey evidence as well. Okay, so let me conclude there and take any additional questions. Slow-moving beliefs about variance can match a lot of puzzling empirical facts surrounding volatility and risk premiums. The key thing that I want to highlight there is this results in underreaction and delayed overreaction to volatility. We see that directly in the volatility claims, and we show through a model that can help explain this puzzling weak risk-return trade-off, as well as a bunch of these other patterns. Last thing, we've directly motivated those beliefs by survey evidence, so they match what we see in the surveys, and then it also matches what kind of the evidence that we've seen at the firm level. So I think I'm right on time here. So maybe I'll end there and I can take any additional questions if we have time for that.